As investors, we trust banks to keep our money safe, and yet sometimes that trust gets eroded and we get the possibility of a bank run. In this video, we assess the safety of the UK banking system in the light of the latest bank stress test from the Bank of England, and we ask the question, could we get a run on UK banks right now? Now, this video is sponsored by Trading 212, which is a UK commission-free investment platform. So let's look at the threat of a UK bank run in a bit more detail. Now, what is a bank run? Well, it's when all of the depositors of a bank are worried that the bank is going to become bankrupt, and so they take their money out before that happens, or at least that's what they hope. And this is often covered in the media with these big queues forming outside banks as people are trying to withdraw their capital. So here you can see a bank run in 1914 in Belgium. Here's a much more recent example in the UK, that was Northern Rock in 2007. And in 2023, we had a similar story in the United States with Silicon Valley Bank and First Republic Bank. And again, we saw these queues of people who are confused, angry, outside one of the bank branches. Now, what's going on here? Surely if you deposit money at a bank, you should be able to withdraw it. Well, that's true, but there is a twist, which is that banks don't actually have your cash on hand. They've already invested it. Now, banks are a business, and with any business, you can look at its balance sheet. This has two columns. The assets, these are the things which generate income for the company, and the liabilities are how the company funded itself. Now, when you put your deposit into the bank in the form of cash, that forms part of the liabilities of the bank. It forms very cheap funding for the bank because they won't pay you a very high interest rate on what's called a sight deposit or a call deposit. That's because you can take your money out at any time you want. It's called runnable money. Now, if you do lock in your deposit for longer, they'll pay you a higher rate because non-runnable money is more attractive to the bank. But what's good about those sight deposits is they provide cheap funding for the bank, but it comes with that runnability risk. But the fundamental problem is that if you have deposited cash at the bank, it's not very profitable for the bank. If you look on the asset side of the balance sheet, there is some cash there, but it doesn't generate much revenue. It's much more profitable for the bank to take the money you've given them and to lend it out at a higher rate of interest than they're paying you. And that difference between the rate at which they lend and the rate at which they borrow from you is called the net interest margin. But the key thing to notice here is the size of the cash on the asset side of the balance sheet and the size of the deposits on the liability side. The size of the cash is tiny and the size of the deposits is very large. That means that if everybody asks for their money back at the same time, there just won't be enough cash in the bank to pay them back. All they can do is to sell some of their assets. And of course, some of those assets are illiquid. It could take a long time to do that. So if there is this kind of herd mentality where everyone's panicking about the solvency of the bank and everyone tries to pull out their money at the same time, the money just is not there. They won't be able to repay you and the bank could become bankrupt. Now, that was a kind of cartoon balance sheet that we looked at. If we look at a real balance sheet for a real bank, and this is JP Morgan, the huge US bank, you can see the size of the deposits is very large. It makes up almost 2/3 of the balance sheet. And in fact, if we compare the size of those deposits with the size of the cash on the asset side of the balance sheet, it's even more extreme than the cartoon balance sheet which I showed you earlier. The size of the cash deposits is absolutely tiny. It's only about $28 billion, whereas the size of the deposits is about $2.3 trillion. So if everybody at JP Morgan asked for their money back, it would be a real problem for the bank. So no bank is immune from bank runs. A key thing to look at, as we'll discuss later, is how much of that money is guaranteed by the government. In the United States, there's an FDIC guarantee of $250,000. Any deposit which exceeds that won't be fully guaranteed by the US government. In the UK, the size of the guarantee is much smaller. It's £85,000. Now, if you do have a deposit which is smaller than that guaranteed amount, you don't really care about a bank run because the government will make you whole. But if you do have a deposit which exceeds that guarantee, that's runnable money. It's absolutely rational to pull out your money if you think the bank could become bankrupt. Now, before we go on to talk about the Bank of England stress test, let me quickly introduce Trading 212, which is kindly sponsoring this video. It's a platform I've been using for some time, and I like it because of its very low fees. But it's not just low cost, it's also very innovative. It was the first European platform to introduce commission-free trading and also fractional shares. If a share is very expensive, you don't have to pay the full amount, you can just buy a fraction of that share. Also, it's got a really innovative feature, which I love, called pies. The idea here is that you can create your own little portfolio within your portfolio. And that way, you can decide what goes into that, the weights of the individual investments, and you can rebalance them once they start to get out of line with your desired weights. And it's literally just one click to rebalance the portfolio. There's also a social feature with pies such that you can publish your pie so other people can see the benefits of your research. Or you can take other people's pies which are published and use it in your own portfolio. Or alternatively, you could copy it and use it as inspiration for your own pie. Now, if you're a viewer of PensionCraft, you get a special offer from Trading 212 where you can claim a free stock worth up to £100. Now, in order to claim that, you need to create a new account, you need to verify it, you need to fund it with a minimum of £1, and you can use the promo code, which is my name, RAMIN, R-A-M-I-N. To assess the riskiness of the UK banking system, we really need to dig into the Bank of England stress tests. So here's Sarah Beedon in a tweet from the Bank of England explaining that all of the banks passed their tests. Now, I might have been able to show you her CV on the Bank of England's website, but unfortunately their stress test didn't stretch to stress testing their website, so I can't show that to you. But in fact, she's the Executive Director of Financial Stability Strategy and Risk, and she's also in line for the Deputy Governor's job at the Bank of England. But what she's saying is that UK banks are resilient and strong enough to support households and businesses, even if we get a huge macroeconomic shock. How does she know that? Well, that's the purpose of the stress tests. Essentially, what the Bank of England does in one of these stress tests is to take lots of macroeconomic variables like growth, inflation, interest rates, and shock them. So, for example, the very extreme scenario that they've created is one in which we get high and persistent advanced economy inflation, not so surprising nowadays, and in order to combat that, we get increasing global interest rates. So for example, in the UK, the bank rate goes from 1% all the way up to 6%. Again, that seems closer to a central case nowadays. But overlaid on that is a global and simultaneous recession. That comes with higher unemployment. It also comes with lower household income due to the higher inflation and very severe falls in asset prices, for example, in the stock market and also in the housing market. So stocks are expected to drop by around 40%, with residential house prices falling by over 30% in the UK. Here's that stress test, the one in 2022 and 2023 in turquoise, alongside previous episodes like the global financial crisis and previous stress tests. And in case you're wondering, ACS is the Bank of England's acronym for this stress test. It stands for Annual Cyclical Scenario. But notice how the ACS is much worse than the global financial crisis if we look at the fall in GDP, if we look at the residential property price fall, if we look at commercial real estate price falls, but also stock price falls. And the rise in unemployment is also considerable. It'll more than double to 8.5% in the UK. But what's really bigger this time around is the inflation shock, which will peak at 17%. The global shock is also large. That simultaneous fall in GDP, you can see compared to the global financial crisis and broken down by region, so global, Hong Kong, China, and US, all of them will suffer a pretty sharp fall in GDP. And that's also reflected in their residential property prices. So all in all, this is a big economic shock. Now the key point here is that Banks have to be able to lend to creditworthy entities, whether they're households or companies, throughout this crisis. If they can't, they risk making the problem worse. And that's what happened during the global financial crisis. To understand that, we have to turn back to our balance sheets. So remember, the assets are there to generate income, the liabilities are how those assets were funded. Now, the GFC, the global financial crisis, was essentially about bad assets on bank balance sheets. And the key thing to understand here is that when the value of assets falls, the value of liabilities have to fall by exactly the same amount. That's how balance sheets work. That's why they balance. Now, there's a really important part of the liability side of the balance sheets, and that's equity. Now, that only increases when a bank or another company issues more stock. It shrinks when a company buys back its own stock. But the other thing which makes it shrink is when the value of the assets of the company, a bank in this case, reduce. So you can think of equity as the loss absorber on the liability side of the balance sheet. The debt never decreases, the deposits never decrease if the bank's assets lose money, but the equity does. So let's say that the value of the loans for this bank decrease a little bit. Well, the asset side of the balance sheet shrunk, the liabilities have now shrunk, but the component which has shrunk is the equity. If more of the loans go bad, presumably because of defaults or people not being able to repay those loans, then even more of the equity is lost. Now you can probably see what's coming. If the loans shrink by enough, the equity gets completely wiped out. And if that happens, the bank becomes bankrupt. So what the regulators want to happen is for the liability side of the balance sheet to contain as much loss-absorbing equity as possible. The banks don't like that because it makes the leverage on the balance sheet smaller and the profits of the bank smaller. So you can think of this as a tug of war between the regulators, who want lots of loss-absorbing equity, and the bank that wants lots of leverage on its balance sheet. And after the global financial crisis, the regulators won. Banks were forced to keep a lot of regulatory capital, loss-absorbing equity on their balance sheet. And the ratio that regulators focused on was CET1, Common Equity Tier 1. Primarily that's this equity that you can see. Now what you want is there to be lots of Common Equity Tier 1 relative to the amount of risky assets on the balance sheet. So it's the ratio of those two things, loss-absorbing equity versus risky loans. That's what the banks have to keep as a high ratio. So that's how banks were scored through the crisis in this simulation. How much did the equity fall? That's the numerator in this Common Equity Tier 1 ratio. And how much did the value of their risky assets fall? The key thing was to keep that fall in CET1 above a certain hurdle rate. If that's the case, then banks never fell into the kind of danger zone where their equity could be wiped out. And if that's true, they can still lend to the economy through the crisis. And as you can see here for the UK, for the largest banks, almost all of them were above the hurdle rate, even at the worst point through this stress test. So it seems as if everything's okay, but I'd argue that's not true. And that's because of liquidity stress. Effectively, what the Bank of England is doing here, and it is a right thing to do, they should be careful about this, is testing the capital adequacy of banks in the UK. Now, this is trying to stop the previous big crisis, the global financial crisis. But what happened in 2023 with Silicon Valley Bank, for example, was a very different problem. The problem this time around was huge and rapid capital withdrawals, amplified by social media. Now, one of the things the Bank of England stress test did look at was a liquidity coverage ratio. Now, this is an attempt to capture the ability of a bank to survive a bank run. Let's imagine that people are pulling their money out of a bank. What does the bank have to do? Well, it has to sell its assets quickly enough to pay them as they run out of the door. So what's really critical is that it has lots of liquid assets, unencumbered assets as they're called, which it can sell very quickly. So the numerator of this liquidity coverage ratio is the amount of non-crashy assets which it can sell very quickly. Non-crashy is very important because what you don't want is to have equity which is crashed at the same time as we've got a bank run. then in the denominator what we're looking at is the total amount of cash that runs out of the door over a 30-day period. Why 30 days? Well, that's the assessment of the regulator as to how long it takes banks to take corrective action. Or perhaps it's the regulator taking corrective action to stop the bank run. Now that's not set in stone, it's just a guess as to how long the regulator will take. And it's also a guess as to how much money is going to flow out in 30 days. Now here's the balance sheet of Silicon Valley Bank. Again, we've got assets on the left-hand side, we've got liabilities on the right-hand side. The deposits in this case were absolutely huge. They made up 82% of the liability side of the balance sheet. What's kind of interesting is that there was a lot of equity. If you remember, JP Morgan had roughly 8% of its balance sheet in equity. Silicon Valley Bank at the end of 2022 had 7.7. So based on its capital adequacy, its CET1 ratio, everything seemed to be absolutely fine. The problem for Silicon Valley Bank came when bond yields rose very rapidly. Then its very supposedly safe treasuries, which it held on its balance sheet, these are the available for sale securities you can see, but also the held to maturity securities, those fell in value very sharply. At the same time, deposits had already started moving out of the bank because of the tech wreck, and the flow of venture capital money had essentially dried up. Then word got out that the bank was insolvent, and whether it was true or not, people began taking out their money. And the size of the withdrawal was absolutely huge. It was $42 billion over the course of a day. Now that's not going to be covered by the liquidity coverage ratio. In order to stop this kind of social media catalyzed outflow, or a modern day bank run, which does get triggered by social media, you've really got to operate in much larger scale, and you've got to assume that it happens much more quickly. So the one thing which I think should be in the stress test, which I was looking for, was what proportion of deposits were above the guaranteed amount in the UK, above that 85k limit. Now I did manage to download the stress test before the Bank of England website crashed, and it's a very long document of 65 pages. Nowhere do we find mention of the percentage of deposits which are covered by the FSCS guarantee. Fortunately, one of the analysts at Numis, which is a UK fund manager, has estimated that proportion. And what they found was that for retail accounts, that's normal people's accounts like you and I, plus small businesses, about 2/3 of those deposits are covered by the guarantee. If we also include large companies, large corporates, that falls to 50% covered by the guarantee. In other words, there's a lot of runnable money in the UK, and the stress test just tells us nothing about it. So what would it take in order to get a bank run in the UK, given what we know? Now, if it's like Silicon Valley Bank, the first step will be some kind of social media content. It could be a tweet. That doesn't even have to be true. It just has to suggest that the bank could become insolvent and could become bankrupt. If that convinces enough people to take out their money, and if there are enough accounts not covered by the FSCS guarantee, then we'd start to see this kind of herd mentality and this snowball effect which creates a run on a bank. The next stage would be those photographs of people queuing outside the bank to take out their money. Once we reach that stage, essentially the game is over. Now, in the case of Silicon Valley Bank, the regulator had to insure all deposits, and once that happened, people, I think, were much less worried about the possibility of further bank runs. There was also a facility where banks could take their treasury holdings, these are their assets, give them to the Federal Reserve in return for a fairly low interest loan, which essentially could let them pay the people as they were leaving the bank. So probably the Bank of England would have to do the same in this scenario. So I don't think the Bank of England stress test addresses the key problem, which is that nowadays, with social media catalyzing these bank runs, they happen much more quickly and in much larger size than they did in the past. So what we really need to know is how much runnable money there is at these banks, how much of their deposits, how many of their deposits are covered by this guarantee. And if it isn't enough, then the regulator has to think about new ways to ensure a bank run doesn't happen. Now, it is a low probability event, so I would say don't panic. It's not going to happen immediately, but I certainly think it's a possibility. Now, don't forget, if you do want to get your hands on a free share from Trading 212, then all you have to do is to create a new account, fund it, verify it, and use our promo code, which is my first name, Ramin, Ramin. And as always, thank you for listening.